So let us try and understand the GloBE info return on the high level first before we dive into the details and the complexities. So what do we need to do? We need to calculate what our GloBE income is, right? What we need to know is whether we have an effective tax rate of 15% or less. If it's less, we need to pay top-up taxes. So in order to calculate what our effective tax rate is, we need to know what our GloBE income is. We also need to know what our GloBE adjusted covered taxes are, and those are going to include the taxes from our commercial accounts plus all the adjustments to match the GloBE income adjustments. And it would also include deferred taxes. And again, the deferred taxes would need to match the GloBE income definition in order not to add things to taxes which are not included in income or vice versa. And then once we have that, we can calculate our effective tax rate. And once we have our effective tax rate, we can also go and calculate our top-up tax. So let's take it from here. Let us talk about GloBE income. What is really happening? So if we have a commercial P&L of a constituent entity here, we've got sales of 1,000, we've got COGS, cost of goods sold, of 200, so we have a gross profit of 800. Then we have some pension fees for employees, which were 100. We've got some fines that we had to pay for 50. We had some other OPEX for 500, and then we end up with an operating profit or an EBIT of 150, right? Now from this, we deduct 50 of interest payments. We received 50 of dividends, and we sold a subsidiary, and we made 100 profit on that. So we end up with an earnings before tax, or an EBT, of 250. And now we calculate our tax, and our tax is 20%. And we have exempt income in dividends and gains from sale of subsidiaries. So we basically have 150 minus 50, which is 100, and then we pay 20 tax on that. And then we have some deferred taxes from something that is another 10 that we deduct. So our net profit is 250 minus 20 minus 10 is 220. Now let us just turn this table around because it makes our GloBE income calculation a lot easier. You can see we took the net profit and we put it at the top because this is what the GloBE return refers to as the financial account net income or losses. And then we take the deferred taxes and the current taxes and put that underneath to work our way back to earnings before tax. And you can see where on the left column we start with the sales, we end with the sales in the right column. Now that we have our commercial P&L upside down, let us look at what happens to our GloBE income, because what we're trying to do with the GloBE income is we're trying to calculate our EBT for Pillar 2 purposes. So there are a number of things in the financial net income that we have that we need to add back and deduct to come to the GloBE income, depending on what the Pillar 2 rules are. So we start and we put the net profit, the 220 that was at the bottom of the P&L, which we turned around and put it at the top. We put it right next to the net profit in our GloBE income, and we say that's 220. Now remember, we are trying to calculate our profits before taxes for Pillar 2 purposes. So obviously we have to add back the deferred tax of 10. We have to add back the current tax of 20, right? We're not quite there yet to have our GloBE EBT, because there are some other issues as well. In Pillar 2, we also have a participation exemption for larger than 10% participations. So we deduct the gain from the sale of subsidiaries from our net profit, and we deduct the dividends because those are not taxable under Pillar 2. And we also need to add back, in this particular case, a arm's length correction for too much interest that we paid into company. 15% of that is under the GloBE Pillar 2 rules not deductible, so we can't deduct the full 50 of interest, we can only deduct 35, so we add back 15. As just an example, right? Fines are not deductible under Pillar 2, so we need to add back the 15 fines that we deducted under our commercial P&L. And they've got a funny rule, and we get to these rules when we get to the individual boxes about the pensions, where they say you can't deduct the pensions that you've accrued during the year for your employees. You can only deduct the pensions that you've actually paid to pension funds. So let's say that we've accrued 100, but we are a little late with our payments because of the way that the invoicing structure works, and 10 of that 100 that we've accrued has not been paid yet. So we need to add that back to our GloBE income because it's a non-deductible cost, right? We haven't paid that yet. And then we end up with our GloBE income, which is 175. And for all intent purposes, our GloBE income are in effect our Pillar 2 or our GloBE EBT. And now we can go and test whether our effective tax rate is below or above 15%. I hope this makes sense for you. And then finally, to put all of this into context, what we've just looked at, that goes into your GloBE income calculation in your GloBE income return under section 3211, and you will recognize these boxes from the GloBE income return and GloBE income return tool that we have available for you. Now that we have the GloBE income before tax, let us look at the taxes themselves so we can calculate our effective tax rate and our top-up tax, right? So we need an effective tax rate of at least 15% not to pay top-up tax. And we need to calculate the rates on the taxes we already provided for in our GloBE income, right? Because we already have this, the financial accounts. So this means we add up all the taxes already in the financial accounts above and below the EBT, right? So this is box 321 where we add all of this. Then obviously you're going to add any adjusted covered taxes which are not in our financial accounts, because if it is in a GloBE account but not in financial accounts, then we need to take those taxes into consideration as well. And you can see here we take the covered tax accrued as an expense in the profit before taxation in the financial account. So you might have some port taxes or some funny taxes which for GloBE purposes are taxes, but for commercial purposes we've treated them as a cost. Then you need to take out any taxes on your financial accounts which is not part of your GloBE income. And there's quite a few here. You can see, first of all, you take out the current tax expense on income which is excluded from your GloBE income. If it's not GloBE income, then the tax doesn't apply either. Otherwise, you overstate your effective tax rate. You take out the current tax expense related to uncertain tax positions, because GloBE rules say we don't take uncertain tax positions into account because you can manipulate them too easily, right? You take the tax when it's due. And you also need to take out the taxes relating to net asset gains and losses. So all the gains and losses that you get the participation exemption for. And then finally, you also need to include all your deferred taxes, right? So you take your deferred tax amount, and that will give you your total adjusted covered taxes. We need to make some further adjustments on this final amount, because it says here, after allocation in Article 4.3, for all constituent entities and jurisdiction. And what they mean when we look at this is the following, right? The aggregate current tax expense after allocations means that, remember, under Pillar 2, some taxes are withheld or paid by some entities which actually relate to the income of other entities, right? And what you do is, to calculate the effective tax rate, you take those taxes which relate to the income of the other entities and you allocate the taxes to those entities, just like you will allocate the income to those entities, right? So when it comes to the current taxes for the constituent entity final, you take the covered taxes of PE income and you either plus or minus that. If you are the PE, you take whatever taxes are allocated to the PE and you add that to the PE as a constituent entity, but you take those taxes out of the headquarters entity because you can't take the same tax twice, right? That is arranged in Article 342A. Likewise, if you have a tax transparent entity, you would allocate the taxes of the transparent entity to the owners of the transparent entity in the ratio that they are also allocated the income for GloBE income purposes, right? So that's dealt with in Article 3.4.2.b. And then you get CFC regime. So also under GloBE income, you may acknowledge CFC regimes. And when you pay tax in the parent entity for the tax which the subsidiary should have paid in its own jurisdiction, you take that tax in the parent entity, you take it out of the parent entity's taxes for adjusted covered tax purposes, and you add that back to the subsidiary for whom you have paid the CFC tax. That's 342C. And then you deal with hybrid entities as well. And here the hybrid entities are then treated as constituent entities for GloBE income purposes. And then you obviously have to allocate the income of those hybrids to those hybrid constituent entities. And you also have to allocate the taxes away from the participants or the owners into the hybrid entity for GloBE adjusted covered tax purposes. And then finally, and this is the important one as well, you need to do the same with the current taxes on profit distributions. Now remember, when you have a subsidiary and the subsidiary qualifies for the participation exemption and it pays out a dividend, the source country might withhold a withholding tax on that dividend, right? And that withholding tax is a kind of a secondary tax on the profits of the subsidiary. Now, because the shareholder is exempt, you cannot include the withholding taxes in the shareholder's GloBE income, even though the dividend belongs to the shareholder, but the dividend is exempt from GloBE income tax, right? But what you can do, and what you have to do under 342E, is you got to take that withholding tax and say, this is an additional tax on top of my subsidiary's GloBE income. And let's see when I calculate my subsidiary's GloBE income, whether the effective tax rate taking the local corporate income tax plus the dividend withholding tax together into consideration, whether that is above or below 15%. And you fill all these things in a separate number of boxes. under 3242 of the GloBE return, and you'll also have this in the Excel tool that we provide, where you take the constituent entity located in this jurisdiction and then the other jurisdiction, and you make the adjustments for basis for the adjustment, and you keep track of this, I assume, through the different years. So that is the total amount of covered taxes, our first data point. But we also have further data points. You see here the current tax expense related to uncertain tax position. I've said before, we don't deal with uncertain tax positions in the GloBE income, so we take that out if it is part of our final taxes. But now when the uncertain tax position gets realized a couple of years down the line and you actually pay the tax, then obviously you need to put that tax back in. Otherwise, you end up paying a tax in your commercial accounts, which never get taken into consideration as part of your GloBE adjusted covered taxes. So when you actually pay that, then you add that back under letter C, covered taxes for uncertain tax position recorded as a reduction to covered taxes in prior year. Otherwise, you never get to deduct your uncertain tax position or never get to add that tax as part of the taxes paid for your adjusted covered taxes. And now we get to the next part of our adjusted covered taxes, and that's going to be the total deferred tax adjustment amount. And the deferred taxes are complicated, but we'll look at them very high level. So we look at letter Q here on our form, and certain tax movements and deferred tax assets and liabilities go through the P&L, right? So when you have losses, let's say of 100, and let's say you're in a 15% corporate tax environment, your commercial loss will not really be 100, it'll be 100 minus a deferred tax asset of 15, so your commercial loss will only be 15, right? Likewise, if you have an asset that you can depreciate, let's say when you acquire it completely for tax purposes, but not for accounting purposes, and maybe you buy something for 100 and you can't depreciate that for commercial purposes in year one, but you completely depreciate it for tax purposes, then you're going to have a deferred tax liability of 15, which is going to run through your P&L in your first year as well, right? And these deferred tax accounts must be taken into consideration. So you start with your movements in your financial accounts, then you adjust your taxes up or down to 15%, because remember we're talking about the GloBE return here. For GloBE tax purposes, we only have a 15% tax that applies. So if you're in a 20% tax environment, your commercial accounts will show 20% on your deferred taxes, and you'll have to trim it down to 15%. And if it's 10%, you can do the opposite for to get it up to 15 if it concerns GloBE income, right? So this is your deferred tax adjustments. You can see you start with what's in your financial accounts, and then you do your recasting. Then obviously you must also adjust it further for whatever is not taken into consideration under the GloBE rules, right? And this is your amount E. And if we break amount E down further, you have separate columns that you fill in. You see you now get to 3221B. You make adjustments, for instance, for deferred tax expense related to items excluded from your GloBE income or your losses under Article 441A. You take changes in your domestic tax rate. I've just said, you need to like recast your rates up or down, and that will go through your commercial accounts. But obviously those rates are not relevant for your deferred taxes for GloBE income tax purposes, because you already adjusted that down to 15%. So if your commercial rate now goes from 25 to 20 and you decrease your commercial tax assets because now you don't have that much tax savings going forward, and that's only relevant for your commercial accounts. It's not relevant for your GloBE accounts. So that we need to take into consideration. And then you get your total amount of adjustments that you need to be making. And you can see that's the amount E that we've got here under 0.5 above in letter A of the tables. And that will give you your total deferred tax adjustment amount. So that's F equals B, which is your recasting plus all your adjustments. And that will give you your total deferred tax amount. And that one you will then put back into letter Q, where you calculate your total deferred tax adjustment amount for your taxes for calculating your effective tax rate against your GloBE income. Once we have done this, we now have all the numbers we need to calculate our effective tax rate. We have our financial income, our net loss. It's just there for reference purposes. We don't do anything with it. We've calculated our GloBE income based on our financial income when we turn the P&L around. We know what our income tax expenses are. We've got that from the financial accounts. And we've also calculated our adjusted covered taxes, including the movements in our deferred tax accounts. So now we simply divide B by A, and we have our effective tax rate. Now, if that is below 15%, we need to go and figure out how we do our top-up taxes and how we split that.